Imagine you're driving a car. You just don't hit the gas and hope for the best. You glance at the dashboard, checking speed, fuel levels, and engine temperature. You want to make sure you're set up for success and speed. And if something's wrong, you certainly want to know before the car breaks down. That's exactly how businesses manage financial performance. Without clear performance indicators, decision makers are driving blind. And that's where CMAs step in. Not just to track financial results, but to measure, analyze, and optimize business performance for sustained success. When people think about financial performance, they often think only about profits. But there's more to it than that. A company can be profitable yet struggle with cash flows or inefficient asset utilization. CMAs focus on key financial indicators, including, of course, profitability metrics. That's your net profit margin. Or you're looking at ROI, return on investment. Then you also have efficiency metrics like working capital management or inventory turnover ratio. Analyzing the cost structure. What's the operational leverage for the business or the level of fixed costs vis-a-vis the variable costs? What's the cost efficiency? What's the break-even analysis? Then you have liquidity metrics, which is the ability to pay short-term obligations with short-term assets. Looking at cash flows, current ratio, quick ratio. You have solvency metrics, which looks at debt or financial leverage. Let's say the debt to equity ratio or the debt coverage ratio. It may be a profitable company, but if it isn't able to pay obligations as they come due, it can even be forced into bankruptcy. And now there's another challenge. If we only measure financial performance, we may miss the full picture. A company may be profitable today, but is it innovating for the future? Are customers happy? Are employees engaged? Enter the Balanced Scorecard, a framework that goes beyond financial metrics to ensure true business success. Now, the Balanced Scorecard takes into account 4 primary perspectives for performance management. The first, of course, is the financial perspective, which is the company making money? Looking at profitability, ROI, cost control. The next one, very important, is the customer perspective. Are customers happy? Looking at customer retention, the net promoter score, market share. The third one is internal process perspective. Is the company operating efficiently? Looking at cycle time, process improvements, quality control. And finally, the fourth perspective is the learning and growth perspective. Is the company building for the future? Looking at employee engagement, innovation, investment on training employees. Now, take the case of Jeff Bezos, the founder of Amazon, who said, if there's one thing I'm certain about, it's that customers will always want lower prices, faster delivery, and more selection. And if we focus obsessively on the customer, everything else will follow.
Hi, Jeff. When you meet Amazon CEO Jeff Bezos, you're immediately struck by 2 things. That legendary laugh and his nearly unmatched focus on customer service.
We know customers like low prices, we know customers like big selection, and we know that customers like fast delivery. And those things are going to be true 10 years from now. They're going to be true 20 years from now. So we can count on those things and we can put energy into them.
This philosophy of customer obsession shaped Amazon's entire business strategy. But how do you measure something as intangible as obsession? Traditional financial metrics won't capture it. And that's where the Balanced Scorecard comes in, helping Amazon track success beyond just profits. So Amazon focuses on learning and growth, which brings about innovation and improves internal business processes. With super efficient internal business processes, Amazon is able to make its customers happy by ensuring fast delivery, seamless returns, and a frictionless experience. And once Amazon had this loyal customer base, profitability didn't even matter, because if the DNA is innovation, processes are super efficient, and customers are happy, it's obvious that profits will follow. Had Amazon focused solely on short-term profits, it would never have become a trillion-dollar company.
Amazon is now worth over $1 trillion. That's an incredible feat for a 24-year-old company that less than a year ago was worth half what it is now.
Instead, by measuring success holistically, from innovation to operational efficiency to customer loyalty, Amazon created an unstoppable business model. Let's take another example. Zomato, one of India's largest food tech companies. It was valued at billions of dollars even before it achieved any profitability. And their story to their investors was, so what if you're not making money? We are focusing on learning, growth, and innovation. We have very efficient business processes and a solid platform. We are focusing on keeping customers happy. And so what if you're not making money today? We'll ultimately make tons of money.
Zomato is the top news maker for today because the company has done a stellar performance in the Q1, where the food delivery platform swung into profits in the quarter gone by. On the sequential basis, Zomato posted a profit of Rs 2 crores versus a loss of 180 crores, beating the analyst expectations.
And this story, of course, made sense. Again, it's the balanced scorecard with a holistic view of performance beyond just the financial perspective. And that's what CMAs do. Help businesses track what truly matters, not just what's easy to measure. Want to master the art of performance management? The CMA is your key to driving profitability, strategic growth, and sustainable success.